Welcome back, it's JWalter here, and here's your latest housing market update. And this is a doozy because mortgage rates have hit the highest levels we've seen since at least 2009. On top of this, home prices have increased by double digits compared to 1 year ago. On top of this, nearly all the major US housing markets are now less affordable than they have ever been. In addition to this, housing affordability is very close to all-time record lows. And this is thanks to a new report from data analytics giant Black Knight. And they actually just published this today at the time of this video, which is May 2nd. So that said, let's go ahead and dive right into the video. And of course, if you guys get any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Also consider subscribing, and I'll keep you posted with the latest housing market updates. So let's go ahead and dive right into the video here. This is an article that was actually just published today at the time of this video. So in this article, they basically say that because we have home prices increasing greatly, a gain of 19.9% from March 2021 to March 2022, and because mortgage rates are now over 5%, that has caused housing affordability to be a big issue, as I've been reporting to you guys for months now, because home prices have been increasing so greatly and mortgage rates are increasing greatly as well. So according to Black Knight, a full 95 of the 100 largest US markets are now less affordable compared to the long-term averages. And that's actually up from only 6 markets at the start of this pandemic. So at the start of this pandemic, which is basically in March of 2020, we only had 6 markets that were deemed to be less affordable out of 100 markets. Now it's 95 out of 100 markets in the United States here that are now less affordable compared to the long-term averages, and that's from 1995 to 2003. So part of the reason why we're seeing this affordability issue is because mortgage rates are above 5% right now. And they're saying that this is near an all-time worst level for housing affordability right now. And by the way, it's going to get worse though, because I'm going to be sharing some stats with you here in just a little bit. In any case, they say in March, home prices increased by 19.9%. However, it was not as much compared to February. So from February 2021 to February 2022, it was 20.1%. As of March, it was 19.9%. Granted, only a 0.2% difference, but still a bit less compared to the prior month, which is a little bit unusual because in March through basically July, home prices tend to increase compared to a year ago and not decrease. So we'll have to see if this trend continues. But right now, home prices have increased greatly year to date so far. So from January to March so far this year, they have increased on average by 6% nationwide. So it says here average mortgage rates are around 5.11%, but that was as of April 21st. However, the impact of these price gains is even more significant because mortgage rates have been increasing. So I want to kind of share a little bit about this 5.11% mortgage rate. And by the way, this is posted today, but the mortgage rates have been increasing. So where they're getting this 5.11% average 30-year fixed rate mortgages is according to Freddie Mac. So Freddie Mac announces weekly averages for mortgage rates. So on the 21st of April, which is about a week ago, they announced the average was 5.11%. However, if you go onto the Mortgage News Daily's website as of today, which again is the 2nd of May, mortgage rates are now 5.55%. So they have increased quite a bit compared to April 21st. And also compared to a year ago as well. I mean, look at this graph here. Starting of the year on the beginning of January, we were at 3.29%. Now we're at 5.55%. So a gain of over 2.2 percentage points in just a matter of 4 months, which is pretty remarkable. On top of this, the averages compared to Investopedia.com, the average 30-year fixed rate mortgage is actually at 5.66%. And both of these are for people with excellent credit, by the way. This rate obviously can vary greatly depending on your FICO score and how much you put down for your down payment. I mentioned that because in this report, they're using 5.11% as the average mortgage rate, but now it's really closer to 5.5 to 5.7%. So housing affordability is going to get worse once they update their numbers here and once they post a new update in about a month here. So here's the significance regarding rising home prices and also rising rates. as measured by the share of the median income required to make the principal and interest payment on the average price home bought with 20% down. In other words, for people who earn the average income in the United States, in order to afford the average price home in the United States, just based on principal and interest payments, housing in the United States was the least affordable back in July of 2006, when it took 34.1% to make that principal interest payment, or that housing payment. So in other words, housing affordability was at its lowest levels in July 2006, when it took a 34.1% of the average income in the United States to buy the average home. So to fast forward to February 2022, we were at 29.1%. The all-time record high, again, was 34.1%. So as of April 21st, that payment to income ratio has now climbed all the way up to 32.5%, within 1.6 percentage points of the all-time record high. That equates to an increase in your housing payment by $522 per month, or a 38% increase since January. On top of this, here's a key stat here, because since the start of this pandemic, that payment has gone up by $790 per month, or a 72% increase since the start of this pandemic. So right now, in order to reach an all-time record high for the payment to income ratio, we only need to increase by 50 basis points for 30-year fixed rate mortgages, or a 5% rise in home prices, and that would push affordability to its worst level on record. And as I've been reporting to you guys, because we're seeing this lack of affordability for housing right now because of sky-high home prices and also mortgage rates, this is causing some people to flock from 30-year fixed-rate mortgages to adjustable rate mortgages. And I've been reporting this to you guys on a basically weekly basis, because the Mortgage Bankers Association has been reporting on a weekly basis that the share of people using adjustable rate mortgages versus 30-year fixed-rate mortgages has basically doubled since January of this year. So Black Knight had some more to say regarding this, because they're saying that these market dynamics, meaning again, we're starting to see more people getting priced out of this market because of a lack of affordability, has made ARMs, or adjustable rate mortgages, increasingly more attractive to borrowers. And this is because the spread between the mortgage rate for a 30-year fixed rate mortgage and an adjustable rate mortgage are now at the widest since 2014. So let me share an example with you guys regarding this, because I've been reporting this to you guys more or less on a weekly basis for you guys. But as mortgage rates are increasing and also the spread has been changing, so does the changes in the estimated housing payments. So here's the 30-year fixed rate mortgage. Let's assume a loan amount of $400,000. So these payment amounts here are based on principal and interest only. It doesn't include taxes and insurance. So in any case, if you're going to get a $400,000 loan right now, the average, according to the Mortgage News Daily, for people with exceptional credit, that would give you a payment of $2,284 per month. If you were to get that same loan of $400,000, your interest rate, or your mortgage rate, would actually be 4.55%. So a difference of 1%. And again, with a $400,000 loan with a 5/1 ARM, meaning it's fixed for 5 years and it's variable thereafter, your payment would be $2,039 per month, or a difference of $245 less per month. So because some people are getting priced out of this market, they're looking at, hey, I can just get a 30-year fixed rate mortgage. My payment's going to be approximately $2,300 for a $400,000 loan. Then why not just get a 5/1 ARM and only pay just over $2,000 per month? And because people are looking at these adjustable rate mortgages and seeing that their housing payment is going to be less, some people are moving to buying and also refinancing with an adjustable rate mortgage and not a 30-year fixed rate mortgage. And because of this, Black Knight is reporting that the ARM share of purchase rate locks by volume, this basically means the share of people who are locking in a mortgage rate in order to buy a house right now, that spiked from 2.5% in December of 2021 to now 8%, or nearly 8%, in March. And that is the highest share since Optimal Blue began reporting the metric back in 2017. If you guys follow my YouTube channel, you guys know that I view this as a more risky loan product than a 30-year fixed rate mortgage. And this is because after that fixed rate term, your mortgage rate and of course your housing payment becomes variable. So it adjusts to current market conditions or current mortgage rates. But it still pales in comparison to the 40% plus of mortgages completed via ARMs at the peak of 2005, which is mind-blowing that at the peak of 2005, over 40% of the purchases were using adjustable rate mortgages, and most of those were interest-only adjustable rate mortgages as well. However, the risk to these loans still remains very low, though, according to Black Knight, because they're saying that ARMs with a 7 to 10 year introductory period, meaning the time period where your mortgage rate and housing payment is remaining fixed, at least for your principal interest payment, that make up the vast majority of ARM originations at 85% in 2021. On top of this, the average debt to income ratio among March ARM blocks remained below 31%. So this is very, very low because people looking to buy a house right now, they need a debt to income ratio of less than approximately 45%. So at 31%, that's still very, very low for conforming loan standards. On top of this, the average credit score was 757, also the highest since at least 2017, and the number of outstanding ARMs are still at the lowest in over 20 years. So even though a lot of these loans are being purchased with a low debt to income ratio and also a high credit score, there still remains some challenges ahead, because if home prices decrease greatly, and of course, if mortgage rates increasing greatly as well, then a lot of these people who are going to be moving to a variable rate in 5 to 10 years from now may be in trouble. In addition to that, Black Knight is reporting this. Nearly 1.4 million active ARMs are in the adjustable phase and may face rate or mortgage rate and also housing payment increases in coming months, driven by sharp rises in underlying ARM indexes. Black Knight will continue to monitor the situation in the months to come. So in other words, nearly 1.4 million homeowners have an adjustable rate mortgage, and they're also at the adjustable phase, meaning they're beyond this introductory period where their mortgage rate is fixed. So these 1.4 million homeowners have an adjustable rate that's adjusting to current market rates. And Black Knight said they're going to be monitoring the situation in the months to come, and I'll also definitely keep you posted regarding that as well, because this is a personal risk and also a personal concern that I have regarding our housing market in the years to come. If you guys got any value out of today's video whatsoever, then please hit the like button. I greatly appreciate that. Hope you have an awesome day. I look forward to seeing you on the next video.